Everyone's focused on the debt ceiling right now, and of course that's a hurdle they have to go through. Whereas I think the biggest question is what happens after the debt ceiling, because when the Treasury is no longer offsetting some of the Federal Reserve policies, I think you're at a risk of a liquidity challenge. And then beyond that, you either see the Federal Reserve probably have to change some of their policies, maybe end quantitative tightening or take other actions, or you need to see the Treasury make unusual actions. Like, for example, they can issue a ton of T-bills to keep funding their large deficits, and I think that a lot of that probably materializes in the second half of this year, or maybe if they push it out, maybe early next year.
The United States has reached its debt ceiling on January 19th for 4 months and 4 days. Nevertheless, a deal to reassure investors that the U.S. is not ready to default on its debt has yet to be reached between the Republican-led House and President Joe Biden. The nation is on the verge of a self-imposed catastrophe, which could significantly harm its reputation on the global arena, according to Janet Yellen, Secretary of the Treasury, who has been issuing warnings over the past few months. Millions of Americans will have their retirement and veteran benefits delayed in the event of a default. In addition, they would have a negative impact on the financial sector and cause a catastrophic recession, which would further destabilize an already strained economy by introducing instability and uncertainty. While the President and the House are still in talks, many people are confident that before the economy collapses, all parties will resolve their differences and come to an agreement. Nevertheless, whether or not there is a default, according to renowned financial analyst Lyn Alden, the harm has already been done. The head of market research at Bitcoin magazine, Dylan LeClaire, and Alden recently spoke in a fireside chat at the Bitcoin 2023 conference. Market Disruptors Mark Moss and the Investors Podcast Network's Preston Pish are both founders. The current status of the American economy and the undesirable options the Federal Reserve and the Treasury Department will have to choose from in the upcoming months are covered by all four. Alden claims that for 40 years, interest rates have been continuously dropping while equity prices have increased. The amount of debt as a percentage of GDP has increased, and equities valuations have continued to rise. Alden thinks that things are about to get very bad since the 40-year machine is running out of fuel right now. Alden predicts that sideways interest rates, falling asset prices, and large deficits will characterize the next phase of the American economy. The eminent macro analyst predicts that the government will adopt some untested and unstable techniques to try to control the issue, which will definitely hurt the economy worse. One of these methods, according to Alden, will be financial repression, which will be used to keep depositors and investors in the collapsing traditional banking system and away from assets like Bitcoin. Please spend a moment liking this video, subscribing to the channel, and turning on post notifications for more interesting discussion segments before we show you snippets from the conversation.
Different things obviously bring people to Bitcoin from different angles. Some people get brought in from the tech route, some people get brought elsewhere, and I think a lot of, in our case, we were brought in by stuff we're watching in the debt markets and the currency markets. That was like a big lens for a lot of us. And so for the past 40 plus years, we've been in this environment of steadily declining interest rates, higher and higher equity valuations, more and more debt as a percentage of GDP, and that's been kind of this like nice coasting scenario. But as we enter this next period where we have maybe sideways interest rates, asset prices that therefore are maybe struggling to go up, deficits that are completely blowing out for demographics reasons, as well as the fact that that 40-year machine is kind of like out of juice now, we enter, I think, a more challenging time. And the analogy that I've often been drawing from, there's no perfect historical analog, but when I look back at the 1940s, it's the last time public debt as a percentage of GDP was this high. I look at it from both the UK angle and the United States angle and other countries. And it's very instructive for this period because, one, it shows how they tackle high debts environments. And some of those are kind of unpleasant, things like capital controls and things like financial repression, that I think it's useful from, say, a Bitcoin perspective to understand these periods, to know how to navigate it, and some of the tools that they're probably going to bring in their tool chest.
I think that's a good point. I mean, looking at historical examples to see how we navigate through this. So you mentioned financial repression. And so when you get the debt to GDP level this high, you have to bring that back down. 130 has been kind of the kill zone. Most countries haven't come back from that, and we're flirting at the 124, 125 range right now. And so historically, how do they bring that back down? Financial repression is a way, and so they want to trap money into the financial system, close off the exits, don't allow you to exit, and then inflation rages high. So you keep bond yields low, inflation rages high, and they basically steal wealth, steal your purchasing power. And so that seems to be the playbook. The IMF wrote a paper on that in 2015, basically spelling that out. We've seen it played in Israel, other places as well. And so how do you protect yourself from that? Well, one way is to get out of that system they're trying to trap you in. And of course, Bitcoin is that escape route.
I think the path we've seen for a while now, ever since, say, autumn of last year, is you've had these two opposing forces. So on one hand, you have the Federal Reserve still trying to tighten policy, whereas the Treasury was actually offsetting some of that. They were actually pushing liquidity back into the market using their Treasury cash account. It's kind of like how if you were not allowed to borrow debt and you lost your income, how would you keep paying your expenses? Well, you'd probably draw down your savings and keep paying your expenses until you basically ran out of savings. And so the Treasury has cash that they hold at the Fed that they have kind of like, in their kind of like liquidity buffer. And so for the past 6+ months, they've been pretty aggressively drawing down that cash balance and putting it back into the market because they couldn't issue more debt. And of course, their tax revenues don't cover it. And so you had Federal Reserve QT, and then you kind of had like Treasury QE. And the challenge, everyone's focused on the debt ceiling right now. And of course, that's a hurdle they have to go through. Whereas I think the biggest question is what happens after the debt ceiling.
We're not China. In China, it's very easy to do these things. They don't have open capital accounts, so they can just kind of close those exits. It's communist. We're the land of the free. So how do they do that? Well, how do they always get you in a cage? Well, it's for your safety. Of course. Fear, fear, fear. Hey, we need to do this for your safety. We can suspend Constitution for your safety. And so, unfortunately, the financial system is under duress. It's crumbling because of the actions they've taken. Of course, living well beyond their means, printing unlimited amounts of money. And so then there's a need for an exit ramp. Well, how do we do that in America, in the land of the free? Well, we do it for your safety. So unfortunately, we need to protect the financial stability by you having an ability to get out of that crumbles, that weakens the financial stability. And so it'll be sold as Bitcoin being a threat to national security. You getting your money out would be a threat to national security. And you don't want to put other people at risk, do you? And so be a good citizen, accept what we do, go into the cage, keep your money inside the system so we can steal it away from you through inflation for your safety.
I think a really good instructive example we see is with some developing countries today that have currency issues. So an example is Nigeria for a while now has kind of severed crypto exchanges from their banking system. So it's actually really hard to make it illegal. There's a lot of enforcement points. It's easy to disregard that. But the lowest hanging fruit that countries can have is just make it either hard or entirely cut off from banks being able to go to these exchange points. And then more recently, we saw Argentina kind of make similar moves where they're dealing with 100% inflation. And so they turn to try to limiting the outflows that are going into things like stable coins, Bitcoin, all these other assets. They want to stem the tide. And even before these types of actions, a lot of these countries have all sorts of restrictions on their citizens' abilities to get dollars. And again, sometimes it's on the individual level, but the easier place to do it is on the banking level, because even though some trickles in and out, it just kind of turns the fire hoses into garden hoses. It kind of slows down the leaks. And so it'd be kind of unprecedented in some ways to see it happen in developed countries, because part of what makes the United States global reserve currency is our open capital markets and all that. But when we go back in history, when you look at, for example, the World War I, World War II environments, last time you had very inflationary environments, last time you had major war, last time you had very high sovereign debt levels. The United Kingdom at the time was the global reserve currency, and they had all sorts of draconian capital controls, securities controls, lending restrictions. That's another thing we see in Turkey recently, is that when they try to keep interest rates low, but they have inflation high, so what do? Then they try to restrict types of lending that people can do so that you can't, for example, borrow Turkish lira and plow it into gold or Bitcoin or dollars or something like that. They try to make that harder to do. And I think it's important not to be asleep at the wheel for some of those risks that could materialize in 3, 5, 10 years as we go through some of these kind of macro transitions that are currently happening and then probably still ahead of us.
It is better to prepare for what is to come by removing your investments and valuables as far out of their reach, as you can then to put more trust in a failing system. For us, that means making investments in Bitcoin and other popular cryptocurrencies, despite their tremendous volatility and the current state of the market. What do you think about Lyn Alden and Mark Moss' assessment of the current state of the US economy? Please share your thoughts and views in the space provided below. Also, make sure you subscribe to the channel, like this video, and enable post notifications so you won't miss any of our regular uploads. Thank you for watching.